Okay, last week I came across a couple of articles regarding Bank of America. They're going to be buying back some of their stock, and you know, just for my own interest. And then light bulb went off. I said, "Hey, this is pretty uh, applicable to the topic in Chapter 8." So I'm going to read these articles for you. Uh, they're from July 11th. So, yeah, about a week ago. Bank of America sets a $2.9 billion stock buyback program through March to pay regular dividend. Shares of Bank of America, the ticker symbol is capital B, capital A, capital C, is up 3.5%, and it was down later in the week. Gained 1.2% in pre-market trading Tuesday after the bank said it authorized the repurchase of $2.9 billion worth of common shares through March 31. The bank also announced a regular quarter dividend of 18 cents a share to be payable March 26 to shareholders of record on March 5. The announcements came ahead of Bank of America's fourth quarter report, which is expected to be revealed later Tuesday. The bank said that the maximum allowed for the period under guidelines established by the Federal Reserve, based on Friday's closing stock price of $33.01, that buyback program could represent up to 87,850,000 shares, or about 1% of the shares outstanding. Bank of America stock has run up 39.2% over the past 3 months. Okay, so let's see, what are they selling at? 33, so it's up 40%. 33 times 26. So 3 months prior to back in January, you could pick it up for $19.80. In March, it's selling for $33. Now, 18 cents a share times 4, let's call it 20 cents. That's 80 cents a year dividends. What would you rather have, 80 cents a year dividends or it going up, let's see, call that 20, 30, $13 a share in 3 months? I'll take the price increase. Now, the stocks can go down in value too. All right. Now, based on what are they doing with the buyback? They're reducing the number of shares available to be outstanding by making something rarer. It's going to push the price up. And we talked in the video, my discussion and lecture YouTube video for Chapter 8 about the formulas for valuing common stock and preferred stock. And again, that's only applicable to stocks that pay dividends. This is another way to value a stock. If the market price is known and the company is buying back so many shares, it could give a value towards the company. By reducing the number of shares outstanding, it's going to push the price of the stock up even higher, theoretically. What does that have to do? This is a management or board of directors tactic to get the price up to, again, maximize shareholder wealth. But what are they doing it? They're not doing it by making more loans and collecting more interest from customers or paying less interest to depositors. They're doing it by a financial manipulation, let's call it. They're not increasing cash flows by doing this. Or maybe they will. Indirectly they will, because the shares they buy back are going to go into what we call accounts called treasury stock, which is going to reduce equity, but they will not have to pay dividends on those shares that they're buying back. So that's going to increase cash flows to the other shareholders. Okay. July 11th, you won't believe Bank of America's massive new buyback program. Here's how much stock Bank of America plans to buy back over the next year. The latest results of the Federal Reserve Comprehensive Capital Analysis of Review, better known as the stress test, were just released. And this goes back to earlier times, but really they toughen these things up in the 2008 through 2012/2013 recession, where the banks were teetering and the credit dried up. So the Federal Reserve regulates the member banks in the Federal Reserve System. And as a result, most of the banks received approval for their upcoming capital plan. So it's not a totally free industry. They are subjugated to a lot of regulation, just like the atomic energy. In fact, I remember years ago when my mom had to go in a nursing home, the person there told me that the nursing home is the most regulated industry. I don't know if it's true. And they said it was even more regulated than running a nuclear power plant. But again, I guess that's because there's a lot of people that are being funded, paid for their care in nursing homes out of Medicare, Medicaid. So the government has a stake in how they are run. Okay, the Bank of America is one of the standouts. Between dividends and stock buybacks, the bank plans to return a staggering $37 billion to shareholders over the coming year, $11 billion more than it returned over the past year. Okay, and again, you put 11 billion over 37. What's that increase? Work out to 11 divided by 37. Stockholder, man. I got a couple shares of it. However, there was one part of the capital plan that really stood out. After the stress tests were announced, Bank of America revealed its capital plan for the coming year, which included buybacks and dividends. And while shareholders are indeed getting a raise, more on that in a bit, the buyback authorization is the big story. And I do mean big. Bank of America announced that it is authorized up to $30.9 billion in stock buybacks over the next 12-month period. Of this amount is to offset equity-based compensation awards. Okay, so they have to give some stock bonuses to their upper echelon employees. But the other $30 billion is simply to buy back shares and reduce the bank's share count. Supply and demand. This represents a 50% increase over last year's $20 billion buyback authorization. So you can see this is not just a one-time thing. It's something they've been doing for several years and probably plan to continue to do as long as their fortunes are on the uptick. Based on the share price of this writing, $30 billion translates to more than 11% of the current outstanding shares. Let's be perfectly clear. This is a very aggressive buyback plan. While the sheer size is certainly a surprise, it shouldn't come as a shock to investors that buybacks still make up the bulk of Bank of America's capital return plan. After all, CEO Brian Moynihan has said in the past that buybacks are the bank's priority. So it's a strategy, not a tactical thing, but a strategic plan. Tactical would be day-to-day operations. Strategic would be over several years. Not only does the bank's management believe that the stock is a good value, but buybacks are a more flexible form of capital return than dividends. Dividends are taxable. Capital return, upping the value of the stock, is a non-taxable event until the person sells the stock. And again, I demonstrated, maybe it was in the chapter lecture and discussion, that you are more apt to increase your wealth through the value of the stock going up than you are by dividends. Dividends are dollars and pennies. Their capital gains are usually $10, $5, $10, $20 bills or sometimes more. It's important to mention that although the bulk, about 83% of the Bank of America's capital return plan, is in the form of buybacks, shareholders will also be getting a dividend increase starting in the third quarter. Bank quarterly dividend is raising from 15 cents to 18 cents, a 20% increase. Yeah, you're thinking from 15 cents to 18 cents, not a lot, but it's you put it on a percentage basis, 20%. Based on the share price as of this writing, this translates to a yield of about 2.6%, which is historically high for a bank. Again, I don't really care about the dividend yield. I'm more concerned about the price appreciation in the stock market. There's one investment I own that I bought for the dividends, and that's because of my age. I'm looking for supplementing my income when I retire. I don't care if that one goes up in price as long as it keeps paying a 10% dividend. lot, 10 times better than what the bank's paying me at 1% or less. Then they give us a chart. I won't bore you with the chart. Then let's see. Is Bank of America stock really as cheap as management seems to think? It's not difficult to see why the Bank of America management is willing to buy back stock. Yeah, you don't want to buy your stock back when it's at its peak price. Like, management, you're going to do this. It's like any other, they're not investing in themselves because you can't own yourself, but they are looking to maximize shareholder wealth, what we saw in Chapter 1 as the goal of management and the goal of investors. And like anybody else, you want to buy it back when it's on its low end, not on the high end, because then you get more bang for your buck. Bank of America has transformed itself into one of the most profitable and efficient banks in its peer group. Its return on assets, 1.2%, and equity, 11.4%, are among the best in the big U.S. banks. And then they talk about another ratio. Not only is Bank of America a much improved institution, but the market has yet to fully reflect the improvement in its valuation. Okay, so if you read this, you might want to buy some BAC stock. The bank trades for about 1.13 times a book value, well below JP Morgan Chase, 1.45, and even scandal-plagued Wells Fargo at 1.21. So as a Bank of America shareholder myself, I applaud, and this is the author, not myself, I applaud the bank's effort to take advantage of its attractive valuation by repurchasing shares in such quantity. It appears the market agrees. The stock jumped 3% after the new capital plan was announced. What does that say? Markets are generally right, okay? So the markets are reacting to the news. Well, this is an old article, but if you take a look at it, it has done well over the last year after coming out of recovery of the push down of the stock market due to the pandemic. In fact, I might have mentioned it earlier. Maybe it was last time I taught 507. When the pandemic really got in high gear, late winter, early spring of 2020, the market went down about 6,000 points from like 25,000 down to 19,000. And I looked at that as an opportunity. Yes, there was some risk there, but you have to be careful on what you're buying and say, is it a company that is going to be hurt by the pandemic, or is it a company that is going to serve, that is going to be, its products and services are going to be used regardless of whether people are at work or not. And again, a little knowledge gives you the edge, or a lot of knowledge gives you the edge on other investors and other finance people. So information is key. And I think that was a nice article, very relevant to Chapter 8. So I hope you enjoyed it.